A 5% dividend can leave you with less than a 1% dividend stock. Why? Today's companies pay out less because reinvesting in technology and intangibles can earn them more. The growth didn't disappear. Waiting on dividends means waiting on your paycheck. The alternative? Manufacturing income from total return, selling high, rebalancing, and pre-funding future spending when markets rise. And when markets cool, you're not forced to sell low. You live off a bond ladder. High yield products often hide concentration, leverage, or no growth at all. The alternative compass is our retirement paycheck system: growth, harvest, guardrails. First up, growth. Why enterprise value, not dividends, actually fuels your paycheck, and how a 1% yielder with high growth can beat a 5% non-grower. Here's the shift that most people miss. Public stock dividends are lower today because companies are plowing cash into AI, software, and data systems, intangible assets where returns can be significantly higher. A manufacturing company in 1990 bought equipment and buildings you could touch. Today's investments in R&D and PhD research scientists don't show up on a balance sheet the same way. The enterprise growth hasn't gone away. So far, it's actually accelerated. The yield mirage is what gets people in trouble. Chasing headline yield often means trading safety for concentration risk, leverage, or hidden fees. We see portfolios all the time stuffed with high yield products that look great on paper. Then you dig deeper, they're concentrated in just a handful of sectors. The companies are borrowing to maintain payouts, or there's a fee buried in the fund eating up half the yield. The moment business slows, the dividend gets cut. Meanwhile, companies investing mindfully into growth, even with tiny dividends, have the potential to create substantially more wealth over time. After inflation and taxes, that high dividend might barely keep you treading water. The real paycheck power comes from total return, not just the coupon or dividend alone. And the key to building and maintaining sustainable wealth? A healthy, diversified mix of sectors, not just one single strategy of income or high growth. We don't simply hunt yield, we harvest growth in tandem. Of course, every situation is unique, and what works for one family might need adjusting for another. So if we're not solely relying on dividends, how do we generate enough cash flow to create dependable paychecks? That's where harvesting comes in. Now let's move to harvesting. How you create paychecks on purpose during up markets. We call it rebalance to pay. When your equity allocation drifts above a target, say you're supposed to be at 60% stocks, but the market pushes you to 65%, that's when you trim the winners. Not because there's anything wrong with them, because they've done their job, and now it's time to fund your lifestyle. Here's the formula. Dig your paycheck. DIG. Dividends plus interest plus realized gains from appreciated stocks. Notice that last part. The gains are just as spendable as dividends, but most retirees treat them like they're radioactive. If a stock doubles, selling 5% of it to fund your retirement isn't depleting your wealth. You still have 95% of a position that doubled. The key is pre-funding. During market rallies, you can bank years of future withdrawals. Not trying to time the market, just avoiding the need to sell when markets inevitably wobble. Think about 2022. Markets experienced significant declines. But if you pre-funded during the prior year's strength, you weren't forced to sell anything. You had cash waiting for the recovery. But if you're depending on this quarter's dividend to pay this quarter's bills, you have much fewer options. Harvesting works best with firm rules that protect you when markets wobble, which brings us to guardrails. Guardrails are the rules that keep income dependable through any market cycle. The rules are simple but non-negotiable. Refill your cash reserves when markets are strong. Pause refills when markets are weak. Resume at target allocations. No emotion, no market predictions, just mechanical rules. Here's how it plays out. Markets are up, your stocks are above your target allocation, you sell and refill the cash bucket and bond ladder. Markets are flat or down, you're below target, you don't sell anything. You live off the cash you pre-funded. Markets recover to your target allocation and you resume the system. But what if markets stay down for extended periods? That's where the bond ladder comes in. Consider building a multi-year ladder of individual bonds or CDs, not bond funds that fluctuate, actual bonds that mature on a schedule. Year 1 matures, that's this year's spending money. Year 2 matures, next year, and so on. This approach can help change your relationship with market volatility. A significant market decline becomes less of a crisis when you have years of spending in bonds, especially if they're treasury notes that are guaranteed by the US government. You're not forced to sell stocks low to pay the bills. The sequence of returns risk, taking losses early in retirement, can significantly impact retirement plans, and you want to avoid it. Not because markets don't recover, because people are forced to sell during downturns and miss the recovery. These guardrails help protect against that. Remember, this is educational content based on our experience working with many families. Your specific situation will determine the best approach. Growth powers it, harvest funds it, guardrails steady it. That's the retirement paycheck system. No more chasing yield into concentrated positions or risky sectors. If you want to see how this fits into a complete retirement plan, click the link in the description below. You'll find free calculators to model your own retirement paycheck, plus a transparent look at how we implement this system for the families we work with. Or stick around for another video, whatever helps you most on your retirement journey. Thanks for spending this time with me.